Hey there, financial enthusiasts, and welcome back to the channel where we demystify the markets and put specific stocks under the microscope. Today, we're diving deep into stock that's popped up on our hard-to-borrow screener with some truly eye-watering metrics, BJDX. We'll break down what makes BJDX interesting from a short squeeze perspective, explore the mechanics of hard-to-borrow stocks, and explain exactly what you need to understand before even thinking about these types of plays. Get ready to learn about cost to borrow, tiny floats, and why extreme numbers don't always mean easy wins. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show logo/chart for BJDX if available, otherwise just stick. Let's get straight into BJDX, a microcap company that recently caught our attention. Interestingly, a specific sector isn't listed for BJDX, which can sometimes indicate a company in a unique niche or undergoing transition. As of our latest data, BJDX has seen a plus 0.0% change today, a plus 0.0% change over the last 5 days, and a plus 0.0% change over the last 30 days. These figures are striking because today's volume stands at 0 shares, with the 30-day average volume also at 0 shares. This translates to a relative volume of 0x average. These zero activity numbers for an otherwise interesting hard-to-borrow stock are a crucial point we'll explore. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important for short squeeze enthusiasts? In simple terms, when you want to short a stock, you first have to borrow shares from a broker. The cost to borrow is the fee you pay the broker for the privilege of holding on to those borrowed shares. This fee is typically expressed as an annualized percentage. Think of it like interest on a loan. If a stock is in high demand to be shorted, or if there are very few shares available to borrow, that fee can skyrocket. It can, and often does, exceed 100% annually, meaning short sellers could theoretically pay back more than the stock's value in fees over a year, just to maintain their position. A high CTB tells us that borrowing shares is becoming expensive and difficult, often signaling strong short interest or a very limited supply of shares. Why this stock is hard to borrow right now. Now let's specifically talk about BJDX. The reason it landed on our screener is its phenomenal cost to borrow fee, currently sitting at 745.4% annualized. Yes, you heard that right, 745.4%. That's an incredibly high number, indicating immense pressure on the supply side of borrowable shares. BJDX also has an estimated float of only 0.9 million shares. A small float means that even a moderate amount of short interest can quickly make shares hard to find, driving the CTB through the roof. While the exact number of shares currently available to borrow is unknown at this moment, CTB like this suggests the pool is likely very shallow. Our internal composite squeeze score for BJDX is 40.5, which, while not a top-tier score, certainly indicates a level of volatility and potential for significant price movement if catalyst emerges. However, remember the zero trading volume we just discussed for BJDX. This indicates extreme liquidity, meaning even with an astronomical CTB, there's currently no active market to actually trade these shares. This is a critical factor and a serious warning sign. Squeeze mechanics explain. So, if a stock is hard to borrow and has a super high CTB, what happens in a short squeeze? Imagine a situation where short sellers have borrowed and sold a significant portion of a stock's small float. If something positive happens, perhaps good news for the company, or simply increased buying pressure, the stock price starts to rise. This rising price, combined with the exorbitant daily cost to borrow, puts immense pressure on those short sellers. They're losing money on their short position as the price goes up, and they're bleeding money daily just to maintain it. At a certain point, some short sellers will decide the pain isn't worth it. To exit a short position, they have to buy back the shares they initially borrowed. This act of buying back, or covering, adds more buying pressure to the market. If enough short sellers start covering simultaneously, it creates a feedback loop. Buying pushes the price higher, which forces more short sellers to cover, pushing the price even higher, leading to a rapid, explosive price ascent known as a short squeeze. However, it's crucial to understand that a high CTB does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. One of the biggest threats to any short squeeze thesis is dilution. Dilution occurs when a company issues new shares into the market, often through offerings like -1s, -3s, or 424B filings. For BJDX, we found no recent dilutive SEC filings in the last 90 days, which is a positive sign for any potential short squeeze scenario. Here's why it matters. If a stock starts to squeeze and the price rises, a company could issue new shares. These new shares flood the market, increasing the supply, which can satisfy the demand from short sellers looking to cover, effectively eliminating the squeeze pressure and often causing the price to plummet. We also checked for reverse splits for BJDX and found no recent reverse splits in our look-back window. Remember that trading these types of volatile, highly shorted stocks carries significant risk. Always approach them with extreme caution and a clear understanding of your risk tolerance. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given BJDX's unique profile and extremely high cost to borrow of 745.4% combined with zero trading volume and price movement, what should you watch for? First and foremost, you need to see actual trading activity resume. The current zero volume means that, despite the high CTB, there's no liquid market for these shares right now. Watch for any material news regarding BJDX that might spur trading. Keep an eye on the cost to borrow fee itself. Does it stay this elevated, or does it start to fluctuate if shares become more available or easier to borrow? Any significant increase in volume would be the first signal that things are changing. With a tiny estimated float of 0.9 million shares, any real buying interest or short covering could have a magnified impact, but without volume, it's all theoretical. Because it's a microcap, even small news items can have a massive impact once liquidity returns. So, there you have it, BJDX, a fascinating stock with an astronomical 745.4% cost to borrow and a very tight 0.9 million share float. These are classic indicators of a stock that could experience a short squeeze, but the current zero trading volume is a major red flag, suggesting extreme liquidity or a data anomaly that requires further investigation. While the absence of recent dilution is positive, without active trading, the high CTB remains a theoretical metric. Always remember to perform your own thorough due diligence, especially with microcap, illiquid stocks like BJDX. If you found this deep dive into BJDX and short squeeze mechanics helpful, please hit that like button, subscribe for more unique stock insights, and let us know in the comments below what other hard-to-borrow stocks you'd like us to analyze next. We love hearing from you. Thanks for watching, and we'll see you in the next one.